She paid every bill on time. That's exactly why she's broke. $12.1 billion. That's what Americans paid in bank fees in 2024. Not investment losses, not bad decisions, fees, per the Financial Health Network. She checked the app on a Tuesday. Balance was $41. Rent was due Friday. She had been there before. You know how this goes. Her paycheck hit on Thursday, 4 hours too late. It always does. The bank covered the gap. $35 for the favor. Every time. That number didn't land there by accident. Someone put it there. We need to talk about who. Overdraft fees aren't new. They go back to the paper check era of 1969. Back then, banks covered the occasional bounce check as a courtesy, not a business model. Today, Chase charged $1.028 billion in overdraft fees in 2024. Wells Fargo collected another $1 billion that same year. Same game, different name. Together, two banks, $2 billion, from people who didn't have enough money. That's not a bank covering a courtesy. That's a fee structure doing exactly what it was designed to do. The average overdraft fee right now sits at $26.77 per transaction. Most debit card overdrafts are under $24 per CFPB data. They're repaid within 3 days. The fee still hits every single time. A $35 fee on a $24 purchase repaid in 3 days. Do the math. The CFPB did. That's a 16,000% annual interest rate. 16,000. Not a payday lender, not a pawn shop. Your checking account. At a bank with a branch on your corner. You ever wonder why there's always a branch on your corner? 11% of banked adults paid at least one overdraft fee in 2024, per the Fed. Sounds manageable, until you see who that 11% actually is. 19% of Americans earning between $25,000 and $49,000 got hit. 6% of those earning over $100,000 paid one, per Federal Reserve data. The system charges more from people who have less. That's not a bug. That's the product. 21% of Black Americans paid an overdraft fee last year. 9% of white Americans. Same bank, same fee, different neighborhood, different balance. Very different outcome. And honestly, that's not even the part that should really bother you yet. Somebody designed this, and I'm going to show you exactly how they kept it going. 9% of accounts generate 79% of revenue. The same people, over and over, funding a billion-dollar line item, per the CFPB. 9% of accounts, 79% of the money. That's not random. That's a system designed to extract maximum value from the people least able to fight back. And it's been running exactly this way since banks started reporting the numbers in 2015. For 5 straight years before the pandemic, overdraft fees ran $11 to $12 billion annually. Consistent, reliable, engineered, $12 billion a year taken from low balance accounts. Since 2000, Americans have paid an estimated $280 billion in overdraft fees total. 280 billion, not from bad investments. From checking accounts going negative by 20 bucks. The average balance of someone who pays the most overdraft fees. Between $237 and $439. That's who they're targeting. Chase made $58 billion in profit in 2024. Record high in banking history. $1 billion of that came from people who went negative on a Tuesday, per federal call reports. They don't need your overdraft fee. They want it. There's a difference. Here's how the mechanics actually work. You swipe your debit card. You're $4 short. The bank covers it. Charges you 35 bucks for a loan that costs them nothing to process. You go negative again the same day. That's another 35. Some banks allow 3 per day. One bad Thursday can cost you $105 in fees, on top of being already broke. The technical term for that is cascading fees. The industry term is overdraft protection. And that's not even the part that should really bother you. There's still one more layer. The credit card side of this runs the same playbook. Different product, same logic. Americans now carry $1.2 trillion in credit card debt, total, right now. That's not mortgage debt. That's not student loans. That's plastic, per the Federal Reserve. The average balance among people carrying debt is $6,730. At an average APR of 22.3%. That's the rate on accounts actually accruing. 22% interest on groceries, on the electric bill, on the copay you couldn't cover. In 2021, the average credit card rate was 14.5%. By mid-2024, it hit a record high of 23.37%. The Fed raised rates to fight inflation. Credit card rates followed immediately, every single quarter. But when the Fed cut rates in late 2024, cards barely moved. Still haven't. It goes up fast. It comes down slow. That asymmetry isn't accidental. It's policy. In 2023 and 24, card issuers earned an average of 20% APR on revolving balances. That's after accounting for 0% promotional offers, per the CFPB's own market report. Banks reported over $140 billion in total credit card revenue in recent years. $89.7 billion of that was pure interest income, not fees, interest, per federal data. That interest came primarily from people who couldn't pay the balance off, not from wealthy users. 46% of credit card holders carried a balance at least once in 2024. 60% of those people had been carrying that same balance for at least a year. A year of minimum payments, interest compounding daily, balance barely moving. Sound familiar? Here's what minimum payments actually look like. $5,000 at 21% APR. Pay only the minimum. You're in debt for 23 years. You pay $7,000 in interest. $7,000 in interest on $5,000 in debt. Per bank rate, that's not math. That's a trap. And the people paying it aren't careless. They're the people whose rent went up $300 in January. They're the people whose paycheck didn't move, who used the card because there was no other option. For black cardholders specifically, 72% who have a card carry a balance, per the Fed. The rewards card system adds another layer. Here's how it actually works. Merchants pay a swipe fee every time you use a card. Those fees fund the rewards of others. Economists estimate the system redistributes $15 billion annually from poorer to wealthier consumers. Low-income cardholders pay higher interest and fund the cashback miles of higher-income users. Per research cited by CNBC, not a conspiracy, a documented transfer of wealth. The math here isn't complicated once you see it. It just requires that you look. And that's not even the part that should really bother you. There's still one more layer. The fee isn't the cost of covering your overdraft. Banks know exactly what that costs them. The CFPB studied it. The actual cost of covering a $24 overdraft is close to zero. Processing is automated, repaid in 3 days. Losses are minimal, per CFPB data. A $35 fee on a $0 cost is a $35 profit every single time. For 55 years, this was legally fine because of a loophole from 1969. Congress never updated it. Banks never asked them to. 1969. Paper checks. The CFPB finally moved to close it in December 2024. That's what it would have cost Chase per overdraft instead of 34. Their lobbyists noticed. The rule would have saved Americans $5 billion a year, $250 per household. The banking industry sued immediately. The American Bankers Association, the consumer bankers. They said the rule exceeded the CFPB's authority. They said it would harm consumers. Then Congress voted 217 to 211. The cap was killed. The rule never took effect. The $5 cap died before it saved anyone a single dollar. Chase's overdraft income grew 7.66% year over year after that vote. Citizens Financial grew theirs by 16.9% the same period. They watched the number go up. They chose to keep it there. That's a decision. $280 billion in overdraft fees since 2000. Congress didn't stop it. Now look at it from their side, because that's where this gets interesting and useful. Look at this from the bank side for exactly 1 minute. Just 1 minute. Stay with me. A checking account with a low balance is a liability to a bank. It costs them to maintain. FDIC insurance, customer service, branch overhead, app maintenance. Every account has a fixed cost. A customer with $400 generates almost no interest income for the bank. But that same customer, if they overdraft twice a month, generates $70 in fee revenue. $70 a month, $840 a year. That's a 210% annual return on a $400 account balance. Now Chase has 86 million customers. Wells has 70 million. Scale that number. The low balance customer isn't a charity case. The low balance customer is the product. That's not speculation. That's what the revenue data shows. 9% generates 79%. The branch on the corner of the low-income neighborhood is customer acquisition. They need those customers enrolled in overdraft. That's where the margin lives. That's the play. Now look at the credit card side from the same angle. The rich customer pays in full. That customer is actually a slight net loss when you factor in rewards and fraud overhead. The customer who carries $6,000 at 22%. That's $89 billion in income. The industry needs revolvers. People who can't pay it off fund the whole ecosystem. So when the rate hit 23%, that wasn't inflation. It was margin expansion. And when the Fed cut rates, cards stayed high. People carrying balances don't shop around. They can't. Switching cards requires a credit check. A credit check requires a good score. A good score requires low utilization. If you're in debt, you're stuck. The system isn't broken for them. It's working exactly as designed. That's the twist. Now look at the rule that Congress killed. A $5 cap, passed in December 24. By April 2025, it was gone. Congressional Review Act. The CFPB is now legally barred from issuing a similar rule without new legislation, permanently. One vote, one spring, and the $5 billion a year fee machine kept running. They'll tell you the rule would have eliminated protection for low-income consumers. Page 47. They'll tell you the market will fix it. Then they'll collect $35. Capital One eliminated overdraft fees in 22. Ally did it in 21. Citibank dropped theirs. They're still profitable. The argument they are necessary is dead. The banks that kept charging do it because they can. And Congress just confirmed it. That's not a market failure. That's a policy choice made by people with industry donations. The system charges most from those with least. The people who could stop it chose not to. That's the crime. Illegal billion-dollar extraction from low balance accounts. Since 2000, $280 billion. Average balance under 400. Chase made $58 billion in profit in 2024. Record high. $1.42. That's what the average savings paid on $100. $58 billion in profit. $1.42 back to you. $1. They called it a partnership. The math called it something else entirely. Now you see it. There's actually a way out of this, a real one. Not a mindset shift. Actual tools. Zeke went through every layer of this, and there are 3 things that work today. They're not secrets. They're legal mechanisms the system never puts in the FAQ. The first one doesn't require good credit, doesn't require savings, just a phone call. The second one targets the interest rate directly. That's where the real damage lives. And the third one is the one that should not exist, but does. Federal law. Actionable today. They're counting on you never knowing any of these. Most people don't. Let's change that. There's actually a way out, real tools. They're counting on you never finding this. Banks have internal hardship policies they don't advertise. Courtesy reversals are real. First-time approval rates run between 40% and 70% depending on the bank. You don't need a reason. You need the phrase, "I'd like to request a courtesy reversal." Chase, Wells Fargo, BofA, all have done it. None put it in the welcome packet. If they say no, ask for a supervisor. The second yes rate is higher than the first. One phone call, 5 minutes, $35 back. That's Tool 1. Every time. Tool 2 targets the rate. Call your card issuer. Ask for a PR reduction. Creditcards.com found that 56% who asked for a lower rate got one. 56%. More than half. The bank doesn't tell you this is an option, ever. The average reduction is 2 to 6 points. On a $6,000 balance, 360 back. Your script. I've been a customer for X years. I pay on time. I'd like a permanent reduction. They will say they need to review. Stay on the line. Let them review. Do not accept a temporary rate. Ask specifically for a permanent reduction to purchase a PR. If the first rep says no, call back. Different rep, different outcome. The policy allows it. This works better if your score has improved. Pull your score first. Know your number. A higher score gives leverage. My score is 720. I'd like my rate to reflect that. Tool 2 costs nothing. Takes 15 minutes. Works for more than half who try it. The system is counting on you not knowing you can ask. That's why it isn't on the site. Tool 3 is the one they really hate. Save this. This is the glitch. This is where it actually gets good. Write it down. It's not on any list you've seen. It comes from the Electronic Fund Transfer Act, federal law, still on the books. Under Regulation E, your bank must have proof that you affirmatively opted in to coverage. Not assumed consent. Affirmative proof, documented, specific to your account. If they enrolled you without that documented opt-in, every fee charged may be illegal. The CFPB issued Circular 24-05 specifically confirming this. Banks are required to keep that record for a minimum of 2 years. Federal requirement. You can request that record directly from your bank. They never put this in emails. Ask for your Regulation E opt-in documentation for overdraft services on your account. Use those exact words. Regulation E opt-in documentation. Write them down before calling. If they can't produce it, that is evidence you were enrolled without consent, per federal law. That makes every fee potentially recoverable, not hypothetically, per CFPB guidance. The CFPB used this to force Atlantic Union Bank to return fees in '23. Regions Bank, same mechanism. 141 million returned to customers. Not a class action, a federal law that already exists with enforcement precedent. If your bank produces the record, you know they have it. If they can't, dispute every fee. File a complaint with the CFPB at consumerfinance.gov. Reference Regulation E. Complaint process is free. Takes 20 minutes. Banks respond to the CFPB fast. Regions Bank paid $141 million because of this exact mechanism. Real refunds. The rule Congress killed in April '25. It would have closed this gap permanently. They killed it anyway. But the opt-in requirement is still federal law. They didn't touch it. That's the glitch. Legal, law with a name, precedent, and the bank never mentioned it. A $35 fee on a $24 purchase, repaid in 3 days, without consent. 12.1 billion collected in 24 from 9% of accounts. Over and over. The courtesy reversal, the permanent APR reduction, the regulation e-request. Use all three. The system is expensive to be poor in, always has been, but it isn't airtight. It never was. They called it a service. The math called it something else. And now you've got the receipts too. He opened the app on Wednesday. The fees were gone. The balance was positive. Not from a miracle, from the math they designed for him to never actually run. He ran the math, he used the scripts, he sent the written requests. 1 billion from Chase, 1 billion from Wells, 12 billion from Americans. That's not an industry, that's an extraction. And the machine just lost a gear. The system doesn't need you to be reckless. It just needs you to be busy. You aren't busy anymore. You're watching. Now go get your money back.